Hello everyone, this is Alvin Mahawan, a student of Doctor of Education in Educational Leadership and Management. In this video, we're going to talk about foundations of profitability analysis. Some of the features and some topics will be discussed by the members with my co-members. The topics includes the tools in profitability analysis, financial forecasting, financial analysis, and other topics. Well, my task is that to discuss with you the foundations of profitability analysis. Profitability analysis, it is an analysis of the organization's profitability output. Output of an organization can be grouped into products, customers, locations, channels, and or transactions. In order to perform a profitability analysis, all costs of an organization have to be allocated to output units by using intermediate allocation steps and drivers. This process is called costing. When the costs have been allocated, they can be deducted from the revenues per output unit. Remain shows the margins of the product, client, location, channel, or transaction. After calculating the profit per unit, managers or decision makers can use the outcome to substantiate management decisions. This is the role now of an educational leaders or administrators to make decisions based on the conducted profitability analysis. Managers can decide to stop selling loss-making products to reduce cost for loss-making customers or to increase sales in profitable locations. In profitability analysis, it is possible to perform Pareto analysis by writing outputs units from most profitable to less profitable. By doing so, it is possible to create the so-called wheel curve showing the potential margin of the organization. But what is profit? Let's talk about profit versus profitability. Why do we need to track profit margins? Here are some important key points so you can see the difference between profit and profitability. What is profit? Profit is an absolute number calculated by total revenues less the total costs. What about profitability? Profitability is a percentage which expresses the ratio between profit and your total revenue. This is also called the profit margin. Basically, profitability means the ability of a company to earn a profit. To illustrate this, consider that Company A sells popcorn and it generates a revenue of 200 pesos and spends 180 pesos. Company A has 20 pesos profit and profitability of 10%. Company B sells gadgets and has a revenue of 20,000 pesos and expenses of 19,980 pesos. Company B has a profit of 20 pesos but their profitability is 0.1%. Profit margin provide a more realistic perspective. Using this example, we can say that profit margins provide a more realistic measures of business performance. They may have the same amount of profit, but we can say that Company A is more profitable than Company B. Now, how to increase profit margin? There are two things that we might consider. These are: review your pricing strategy. Second, know the behavior of your expenses. The safer approach is to control costs. Let's proceed to the importance of cutting costs. A minor decrease in cost will improve your profit margin more than a comparable increase in total sales. Look at every aspect of your business and how you can control your cost. Profitability analysis is a component of enterprise resource planning that allows administrators to forecast the profitability of a proposal or optimize the profitability of an existing project. Well, profitability analysis can anticipate sales and profit potential is specific to aspects of the market such as customer age groups, geographic regions, or product types. Profitability analysis can help key personnel in an enterprise too. These are: identify the most and least profitable clients, identify the most and least profitable products or services, discover which sources of information offer the most reliable facts, optimize the products mix to maximize profits in the medium and long term, isolate and remedy the causes of decreasing profit margins. Profitability analysis enables you to evaluate market segments, which can be classified according to products, customers, orders, or any combinations of this, or a strategic business units such as sales organizations or business areas with respect to your company's profit or contribution margin. The aim of the system is to provide your sales, marketing, product management, and corporate planning departments with information to support internal accounting and decision making. There are two forms of profitability analysis. These are costing-based and account-based. What are these things? First, costing-based profitability analysis is the form of profitability analysis that groups costs and revenues according to value fields in costing-based evaluation approaches, both of which you can define yourself. It guarantees your access all times to a complete short-term profitability report. What about account-based profitability analysis? It's a form of profitability analysis organized into accounts and using an account-based valuation approach. The distinguishing characteristic of this form is its use of cost and revenue elements. It provides you with a profitability report that it permanently reconciles with financial accounting. Those are some of the foundations of profitability analysis, and I do hope that you learned something from this discussion. Some of the important features and topics will be discussed some of my groupmates. See you in the next video.